Imagine you are standing in the center of Zurich on a crisp Sunday evening in March 2023. The air is cold and the streets around Paradeplatz are usually silent this time of week. But tonight, the lights in the grand stone buildings are blazing. You watch figures in expensive suits hurry through heavy glass doors. Their faces look tired and their phones never stop buzzing. In this moment, a pillar of global finance is literally crumbling behind those walls. It is a strange sight because Swiss banks are supposed to be the most boring, stable things on earth. For over a century, the Swiss vault was the ultimate symbol of safety. Then, in a single weekend, that image shattered. The numbers coming out of the headquarters were staggering. In just a few months leading up to this night, Credit Suisse lost over $100 billion in deposits. That is enough cash to fill a stadium or run a small country for a year. You probably assumed a bank that old and that massive could never truly disappear. But by that Sunday, the government realized the bank wouldn't survive until Monday morning. There was a genuine fear that if the doors didn't open with a solution, the entire global banking system might catch fire. This leads to a massive question that the world is still trying to answer. If the Swiss can't keep a bank safe, who can? The crisis didn't happen in a vacuum. It was the result of years of scandals and bad bets. But the final straw was a simple loss of trust. During that frantic weekend, the Swiss government did something unthinkable. They forced the country's biggest bank, UBS, to buy its dying rival, Credit Suisse. They called it a merger, but everyone else saw it as a marriage at gunpoint. There was no time for shareholders to vote. There was no time for a slow transition. The Swiss finance minister, Karin Keller-Sutter, later admitted that letting the bank go bankrupt would have been a global disaster. So they broke their own rules to save the brand. Picture the scene inside the government meeting rooms in Bern. People were surviving on black coffee and adrenaline. They were looking at spreadsheets that showed money flowing out of the country like water through a sieve. This wasn't just about one bank. It was about the reputation of Switzerland itself. For generations, the Swiss brand was built on three things: stability, neutrality, and secrecy. That weekend, all three were tested. The government had to provide over 200 billion francs in liquidity backstops just to keep the lights on. It was a massive gamble using the taxpayers' money to bail out a giant that had behaved recklessly for years. Then there was a shock to the investors. In a move that sent shockwaves through the markets, the government wiped out $17 billion worth of risky bonds. Usually bondholders are supposed to be protected more than shareholders. Here, the rules were flipped upside down. You can imagine the fury in the boardrooms of London and New York the next morning. It felt like the Swiss were making up the rules as they went along. Finance people still go back and forth on whether the Swiss government overstepped its legal authority by bypassing the usual shareholder protections. Some say it was a necessary surgery to save the patient. Others argue it left a permanent scar on the country's reputation as a predictable place to do business. While the banking towers were shaking, something else was shifting in the background. Switzerland was moving away from its famous neutrality. For centuries, the country stayed out of global conflicts. This was great for business because it meant you could take money from anyone without asking too many questions. But when the war in Ukraine began, the world changed. Under immense pressure from the United States and the European Union, Switzerland agreed to freeze the assets of sanctioned individuals. This was a massive pivot. For the first time, the vault of the world was picking a side. Imagine being a high net worth client from an emerging market. You chose Switzerland because you believed they would never touch your money, no matter what happened in geopolitics. Now, you watch the news and see that the Swiss are blocking accounts and reporting data. The invisible nature of Swiss wealth was evaporating in real time. This realization hit the global elite hard. Reports from the time showed a sudden spike in interest in other financial hubs. Places like Dubai and Singapore started looking a lot more attractive. These cities offer the kind of no questions asked vibe that Zurich was starting to lose. The tension during that 2023 merger wasn't just about the math, it was about the ego of a nation. Switzerland is a small country that punches way above its weight because of its banks. When you see a bank like Credit Suisse, a firm that helped build the country's railroads and its modern economy, getting swallowed up for pennies on the dollar, it feels like an identity crisis. The public was angry. They saw wealthy executives getting bonuses while the government used public funds to fix the mess. Protesters even gathered in the streets, which is a rare sight in the polite world of Swiss finance. The fallout was immediate. The combined bank, the new UBS, became a monster. It was suddenly twice the size of the entire Swiss economy. This created a new kind of fear. If the new UBS ever gets into trouble, there's no one left to save it. The government can't afford a second bailout of that size. It's like having a whale in a swimming pool. It's magnificent to look at, but if it starts thrashing around, the whole pool is going to break. The story of 2023 wasn't just a bank failure, it was a signal that the old ways of doing business were dead. The secret bank accounts, the see no evil neutrality, and the ironclad stability were all under fire. You see, the world has become too interconnected for any one place to stay truly hidden. Transparency isn't just a buzzword anymore, it's a global requirement. The Swiss tried to hold on to their secrets as long as they could, but the pressure finally cracked the vault. As the sun rose on the Monday after that historic weekend, the markets opened to a new reality. Credit Suisse was gone. UBS was now a global titan with a heavy burden. And the Swiss government was left trying to explain to its citizens how they ended up here. The drama didn't end with the merger. It was actually just the beginning of a much larger struggle. Switzerland had to figure out how to be a financial leader in a world that no longer valued secrecy above all else. The transition was messy and loud. You could hear the debates in the cafes and the parliament buildings. People were asking if the era of the Swiss banker was over. If you can't offer total privacy and you can't guarantee total stability without a massive taxpayer bailout, what is your edge? This question hung over the country like a fog. The safe harbor was looking a bit stormy. In the weeks following the merger, filings showed that thousands of wealthy clients were moving their portfolios. This wasn't a slow walk, it was a sprint. The wealth management world is built on the idea that money is cowardly. It runs away from uncertainty. And in 2023, Switzerland felt more uncertain than it had in decades. The legendary Swiss secrecy wasn't just a law, it was a feeling. Once that feeling of absolute safety is gone, it is incredibly hard to get back. The world watched as the Swiss flag, once a symbol of the ultimate financial shield, seemed to lose a bit of its luster. The merger was a bandage, but the wound underneath was deep. It involved the very core of how the nation viewed itself. They were no longer the outsiders watching the world's chaos from a safe distance. They were right in the middle of it, playing by the same messy rules as everyone else. This shift was the first major domino to fall in the story of why the old version of Switzerland is failing. Imagine you are back in the mid-20th century, walking through the quiet, wood-paneled halls of a private bank in Geneva. The carpets are thick enough to swallow your footsteps. There's no loud music or flashing screens. The only sound is the soft ticking of a clock and the rustle of paper. This was the era of the legendary numbered account. Back then, your name wasn't on the file. You were just a series of digits in a ledger. Under the Swiss Banking Act of 1934, it was a literal crime for a banker to tell anyone, including foreign governments, who owned that money. This wasn't just a policy. It was a sacred vow that shaped the entire identity of the country. For decades, the world's elite viewed Switzerland as a black hole, where wealth could disappear and stay safe from prying eyes. But stories of absolute secrets usually have a shelf life. You notice the mood shift around 2008. The air in these banks started to feel different. It wasn't about prestige anymore. It was about survival. The United States government was looking for missing tax dollars, and they knew where to find them. The Department of Justice began breathing down the necks of Swiss executives. They wanted names. This created a level of tension the Swiss hadn't felt since the World Wars. The Swiss government was caught in the middle. If they protected the banks, they risked being cut off from the global financial system. If they gave up the names, they killed their most famous product. This tension boiled over when a whistleblower named Bradley Birkenfeld decided to talk. He was a banker who grew tired of the games. Reporting at the time detailed how he smuggled data out of the country, once even hiding a client list inside a hollowed-out chocolate box. It sounds like a bad spy movie, but the consequences were very real. You see headlines about Bradley Birkenfeld and the massive fine that followed. UBS eventually agreed to pay $780 million to avoid criminal prosecution. More importantly, they agreed to hand over the data of thousands of American clients. The seal was broken. The ironclad secret had a massive, visible crack. The scene in the U.S. Senate during these investigations was explosive. Imagine a room full of politicians waving a training manual found inside a Swiss bank. This manual reportedly taught bankers how to coach clients on avoiding detection. One senator famously said the Swiss were using secrecy as a shield for tax cheats. This public shaming was a disaster for the Swiss brand. They weren't seen as neutral protectors anymore. They were being framed as a getaway car for global tax evasion. The pressure didn't stop with the US. Soon, the European Union and the OECD were knocking on the door too. The transition from wealth protector to tax informant was incredibly painful for the local banking culture. Think about a veteran banker who spent 30 years promising clients total privacy. Suddenly, he is told he has to report his clients to the authorities. This wasn't just a rule change, it was a professional betrayal. Many older bankers simply retired because they couldn't stomach the new reality. The prestigious image of the Swiss banker began to fade. They were no longer the mysterious figures from a Bond film. They were becoming compliance officers for a global tax grid. Now, you look at the year 2017. This was the final nail in the coffin. Switzerland officially began the Automatic Exchange of Information, or AEOI. This sounds like boring bureaucratic jargon, but it was a revolution. It meant that every year Swiss banks would automatically send financial data to over 100 other countries. No more waiting for a court order. No more long legal battles over specific names. The data just flows out through a computer system. The era of the hidden account was legally and technically over. If you have money in Switzerland today, your home country likely knows exactly how much is there. You might think this only affects the super rich, but it changed the life of every ordinary Swiss citizen too. The banking sector makes up about 10% of the country's GDP. When the secrecy model died, the banks had to find a new way to make money. They started charging higher fees. They became more selective about who they would take as a client. The Swiss advantage was shrinking. For a long time, analysts still argue about whether the total surrender of secrecy was actually necessary for the nation's survival. Some experts believe the Swiss could have fought harder to keep their privacy laws. Others argue that if they hadn't given in, the country would have been blacklisted and ruined. There's still a real disagreement on whether the Swiss were actually victims of international bullying or just finally getting caught. Many Swiss people feel like larger nations simply wanted a piece of their pie. They see it as a loss of sovereignty. At the same time, the global community viewed it as a long overdue cleanup. This friction created a deep sense of unease within the country. The Swiss were proud of their independence, but they were discovering that in a digital world, you can't be an island. The technical reality of 2017 was a massive logistical hurdle. Imagine the IT departments in Zurich and Geneva. They had to build systems that could talk to tax authorities in places like Brazil, India, and Germany. They had to sift through millions of accounts to categorize who lived where and what they owed. This was a monumental shift from the old days of paper ledgers and handshakes. Filings from the time showed that the cost of compliance was skyrocketing. Smaller banks, which couldn't afford these expensive new systems, began to merge or shut down. The diversity of the Swiss banking landscape started to thin out. You trace the data flowing out and realize that the world's vault is now more like a glass house. The transparency is total. In the first year of the AEOI, Switzerland sent information on roughly 2 million financial accounts to partner states. That is a staggering amount of data for a small nation to process. It wasn't just a policy on paper. It was a massive operation that signaled the end of an era. The world was watching to see if the money would stay or flee. The drama of this period was often hidden behind polite press releases, but inside the meeting rooms it was chaos. There were stories of clients flying into Zurich to close their accounts in person. They were angry and confused. They felt the Swiss promise had been broken. Some clients even moved their gold into private bunkers outside the banking system just to stay off the digital grid. This created a boom in the private vault business, which operates under different rules than banks. It was a frantic scramble to find the last remaining shadows. While the secrecy was dying, the Swiss economy had to brace for the impact. The country had built a massive industry on a foundation of privacy. Now that the foundation was gone, the house felt shaky. Many people wondered if Switzerland would just become another normal country with normal banks. That sounds fine for most places, but for Switzerland, being normal is a step down. Their entire value proposition was being exceptional. The shift also changed how the Swiss looked at their own government. For years, the politicians in Bern had defended secrecy as a matter of national pride. When they finally signed the international agreements, it felt like a retreat. This sparked a debate about the future of Swiss identity. If you aren't the world's secret vault, what are you? Are you just a beautiful place for tourists and watches, or can you reinvent yourself as a hub for something else? This identity crisis was the quiet backdrop to the loud bank failures that would come later. The death of the secret wasn't a single event. It was a slow, agonizing process of a nation being forced to join the modern world. The world wanted transparency, And eventually, the world got it. But in the process, Switzerland lost the one thing that made it unique in the financial world. The ironclad secret turned out to be made of paper, and by 2017, that paper was being shredded in front of everyone. Imagine you are looking at a map of Europe during a time of crisis. For over 200 years, Switzerland was the blank spot in the middle of the chaos. It was the eye of the storm where nothing ever changed. This was the country's greatest marketing tool. It wasn't just about avoiding wars. It was about telling the world that no matter who was in power or what borders were shifting, your money in Switzerland was untouchable. Neutrality was the bedrock of the Swiss brand. Then, in February 2022, that bedrock started to crumble. You noticed the shift during a historic press conference in Bern. The Swiss president at the time, Ignacio Cassis, stood before a room full of reporters. He looked solemn. He announced that Switzerland would fully adopt the European Union's sanctions against Russia. This meant freezing billions of dollars in assets belonging to powerful individuals. To a casual observer, it seemed like a moral victory, but to the global financial world, it was a seismic event. The neutral label was officially gone. Switzerland had picked a side in a major European conflict for the first time in modern history. This decision triggered an immediate internal political backlash that is still shaking the country today. On one side, you have the government and younger urban citizens who believe Switzerland must stand for democratic values. On the other side, there is a powerful group of traditionalists led by the Swiss People's Party. They argue that by giving up neutrality, the government has committed economic suicide. They believe the country's only job is to stay out of trouble and keep the banks running. This isn't just a small disagreement over policy. It is a fight for the very soul of the nation. There is still a real disagreement on whether this pivot was a brave moral stand or a massive strategic blunder. Some analysts argue that if Switzerland hadn't joined the sanctions, it would have been isolated and treated like a pariah by the West. Others say that by joining, the Swiss destroyed their unique selling point. They are no longer a safe harbor for everyone. They are now just another Western financial hub following the lead of Washington and Brussels. This loss of independence has left the country feeling exposed. The Neutrality Initiative is a perfect example of this tension. Imagine a group of dedicated activists standing in a rainy town square with clipboards. They aren't there for a local charity. They are collecting signatures for a constitutional amendment. They managed to gather over 130,000 signatures to force a national vote on neutrality. Their goal is simple. They want to write a strict definition of neutrality into the Swiss constitution. They want to make it illegal for the government to ever join another sanctions regime. The signatures are a clear sign of how divided the public has become. For the older generation, neutrality wasn't just a law, it was their armor. They remember a world where being Swiss meant you were safe because you were nobody's enemy. Now they watch the news and see their leaders being praised in Brussels but criticized at home. This internal friction makes the country look unstable to outsiders. And if there is one thing money hates more than taxes, it is instability. Now look closer at the consequences in the global market. While the politicians in Bern are arguing, the world's elite are moving their pieces on the chessboard. Reports from major wealth managers began to show a clear trend. Money was leaving Switzerland and heading for places that still promised to stay out of global squabbles. You watch the rise of Dubai and Singapore as the new favorites for international capital. These cities are actively marketing themselves as the new Switzerland. Dubai, in particular, has become a massive magnet for the money that used to flow into Zurich. They have a very simple pitch. They tell investors that they don't care about the geopolitics of Europe. They offer high-end luxury and absolute privacy without the threat of sudden sanctions. It is a formula that worked for the Swiss for a century, and now they are watching their own playbook being used against them. High net worth individuals from the Middle East, China, and even parts of Europe are starting to hedge their bets. They might keep some money in Switzerland for the prestige, but the core of their wealth is migrating. The scene at the Singapore airport is another telling micro-scene. You see a rise in the number of family offices being set up by the global elite. These are private firms that manage the wealth of a single family. Singapore has made it incredibly easy for these firms to operate. They offer tax incentives and a stable, pro-business environment that feels familiar but more modern. For an investor in Asia, the flight to Singapore is shorter, and the regulatory environment feels less judgmental than the new, transparent Switzerland. Inside the Swiss banks, the mood is one of quiet panic. The relationship managers who used to fly around the world to court clients are now spending their time on the phone. They are trying to explain that Switzerland is still a safe place. They are trying to convince clients that the 2022 sanctions were a one-time exception. But it is a hard sell. Once you show you are willing to freeze accounts, the trust is broken. In the world of high finance, trust is like a mirror. You can fix it if it breaks, but the crack is always visible. The economic data backs up this feeling of a slow exodus. While total assets under management in Switzerland haven't collapsed overnight, the growth has stalled compared to its rivals. This is the definition of a slow motion failure. It isn't a sudden crash, it is a gradual loss of relevance. Switzerland is no longer the default choice. It is now just one option among many. And in a competitive world, being just an option is a dangerous place to be for a country that relies so heavily on its financial sector. The tension isn't just about the super rich, though. Ordinary Swiss citizens are feeling the ripple effects. The cost of living in cities like Zurich and Geneva is among the highest in the world. For a long time, the high salaries in the banking sector helped prop up the local economy. But as the banks struggle and the secret accounts disappear, that wealth isn't trickling down like it used to. There is a growing sense of resentment. People are asking why they should support a banking system that no longer provides a unique advantage to the nation. You realize that the safe harbor status wasn't just a label. It was an ecosystem. It included the lawyers, the luxury watchmakers, the private schools, and the high-end real estate agents. All these industries are connected to the flow of international capital. When the flow slows down, the whole ecosystem feels the chill. The Swiss failure isn't just about a few balance sheets. It is about a change in the weather for an entire country. As the debate over the Neutrality initiative moves toward a final vote, the stakes couldn't be higher. If the initiative passes, Switzerland might regain some of its old reputation, but it would alienate its biggest trading partners in Europe. If it fails, the country will continue its path toward full integration with the West, losing its neutral identity forever. It is a classic no-win situation. The world has moved on, and the Swiss are left clutching a map of a world that no longer exists. The era of the blank spot on the map is over. Switzerland has been forced out of the shadows and into the bright, harsh light of global politics. They are discovering that being like everyone else is a very expensive way to live when your entire economy was built on being different. The marketing tool of neutrality hasn't just been shattered. It has been replaced by a question mark that the world's investors are still trying to figure out. Imagine looking at the skyline of Zurich today and noticing something different about the atmosphere. The mountain air is still crisp and the lake is still blue, but there is a heavy shadow hanging over the financial district. You see the logo of just one bank dominating the landscape in a way that feels a bit overwhelming. After the collapse and rescue of Credit Suisse, the survivor, UBS, became something more than just a company. It turned into a financial titan that is now roughly twice the size of the entire Swiss economy. To put that into perspective, it is like having a single engine that is twice as heavy as the boat it is supposed to power. If that engine ever stalls, the boat doesn't just slow down, it sinks to the bottom of the lake. This massive size has created a terrifying reality for the regulators in Bern. They are currently locked in a scramble to manage a banking balance sheet that is now around $1.6 trillion. For a country with a GDP of roughly $800 billion, those numbers are hard to wrap your head around. It means the bank is holding enough assets to buy every single house, business, and chocolate bar in Switzerland twice over. You realize this isn't just a bank anymore. It is the national insurance policy, the national risk, and the national identity all rolled into one. The Swiss government has effectively bet the entire future of the country on the success of a single private board of directors. The tension in the meeting rooms of the Swiss Financial Market Supervisory Authority, or FINMA, is thick enough to cut with a knife. Picture a group of regulators staring at a giant digital dashboard of global risk. They are looking at filings that show UBS now manages $5 trillion in total invested assets. Reporting at the time of the merger highlighted a frantic effort to write new rules on the fly. They need to ensure that this new superbank has enough capital to survive a global meltdown. But there is a catch. If they make the rules too strict, the bank might lose its competitive edge and move its headquarters to London or New York. If they make them too loose, they risk a repeat of 2023, but on a scale the government can't possibly fix. This brings us to the too big to fail paradox. It is the ultimate catch-22 of modern economics. Because UBS is so vital to the country, the government can never let it die. The bank knows this, the investors know this, and the taxpayers certainly know this. Analysts still argue about whether this implicit government guarantee actually encourages the bank to take bigger risks. After all, if you know your parents will pay your credit card bill no matter what, you might be tempted to spend a little more at the mall. In the world of high finance, those spending sprees involve complex derivatives and global bets that can go south in seconds. The public mood in Switzerland has shifted from pride to a sort of simmering resentment. You can almost feel the collective breath being held every time the bank releases an earnings report. People are no longer impressed by the massive profits. Instead, they are looking at the executive bonuses with a newfound sense of anger. In 2023, even as the country was reeling from the banking crisis, top executives at the big banks were still pulling in multi-million-dollar paydays. This didn't sit well with the average citizen who is watching the cost of milk and rent climb higher every month. You hear the arguments in the local pubs and cafes from Geneva to Lugano. People are talking about how the Swiss way used to be about modesty and hard work. Now, it feels like a small group of bankers is playing a high-stakes game with the country's reputation. A recent TV segment featured a local baker who pointed out that if he ruins a batch of bread, he loses money. But if a banker ruins the national economy, they get a parachute made of gold. This sense of unfairness is eroding the social contract that held Switzerland together for centuries. The country is famous for its direct democracy, where citizens vote on everything from trash collection to fighter jets. Now, many feel that the most important part of their lives, their financial stability, is completely out of their hands. Look at the official filings from the Swiss National Bank, and you see a quiet, nervous preparation for the worst. Or they are building up liquidity buffers and asking for more power to intervene before a crisis hits. But there is a structural problem that no amount of paperwork can solve. In the past, if a bank got into trouble, the government could find a buyer. That's exactly what they did with Credit Suisse. But now that UBS has eaten its only local rival, who is left to buy UBS, there is no big brother bank left in the country. The only possible saviors would be foreign giants like JP Morgan or a massive bailout from the Swiss taxpayers that would likely bankrupt the state. The risk isn't just theoretical. One bad trade in a satellite office in Singapore or a sudden collapse in the US real estate market could trigger a chain reaction. Because the bank is so large, a loss of just 5% of its assets would be enough to wipe out the government's entire annual budget. It is a level of concentration that most economists find deeply alarming. You watch the news segments where financial experts try to sound calm, but their eyes tell a different story. They know that the margin for error has basically vanished. The drama of this giant in a small pond extends to the everyday life of the Swiss people. The cost of living in Zurich is already legendary, but the dominance of a single bank is making things even tighter. Small businesses are finding it harder to get loans because the superbank is more focused on global wealth management than on local dry cleaners or hardware stores. The banking diversity that once fueled the Swiss middle class is being replaced by a monolithic structure that feels distant and cold. Meanwhile, the political pressure is mounting. Some members of parliament are calling for the bank to be broken up into smaller pieces. They argue that the only way to protect the country is to make sure no single company is more powerful than the government. But breaking up a bank that is already integrated is like trying to take the eggs out of a cake after it's been baked. It is a messy, expensive, and potentially dangerous process that could trigger the very panic everyone is trying to avoid. You sense a change in the wind as the government prepares its next set of banking laws. It feels like a high-stakes poker game where no one knows the other person's hand. The bank argues that it needs to be big to compete with the Americans and the Chinese. The government argues that it needs to be safe to protect the Swiss people. And in the middle, the citizens are left wondering if their life savings are sitting on top of a ticking time bomb. The reality of 2023 showed that even the most prestigious institutions can disappear in a weekend. Now that the safety net has been used once, everyone is wondering if it will hold a second time. The Titan is magnificent to look at, but its sheer weight is causing the floorboards of the country to groan. The success of Switzerland is now inseparable from the success of UBS, and for a nation that prides itself on independence, that is a very uncomfortable place to be. The fallout from this merger isn't just about numbers on a balance sheet. It is about the power dynamic between a sovereign nation and a private corporation. When a company becomes larger than the state that hosts it, who is really in charge? This question is at the heart of the current Swiss struggle. They saved the bank to save the country, but in doing so, they might have created a burden that is simply too heavy to carry in the long run. the safe harbor has become a one-ship port, and that ship is so large it can barely turn around without hitting the docks. Imagine walking through the departure lounge of a private terminal in Zurich. The silence is heavy. You notice that the passengers aren't the usual European industrialists who have kept their family fortunes here for generations. Instead, the faces are younger, and the destinations on the screens point toward the east and the desert. There is a quiet but steady exodus happening. The old money that once defined the Swiss experience is looking for a new home. For centuries, Switzerland was the only game in town. Now, it is just one of many options in a globalized world where capital can move at the speed of a mouse click. The move toward Abu Dhabi and Hong Kong isn't just a trend. It's a shift in the global center of gravity. These cities are rolling out the red carpet for the wealth that used to hide in the Alps. In Abu Dhabi, the government is building an entire financial ecosystem from scratch, specifically designed to mirror the stability of the old Swiss model but with a modern, high-tech twist. They don't have the baggage of centuries-old secrecy laws that are being dismantled by international pressure. They offer a fresh start. You see reports of wealth managers who used to spend their entire careers in Zurich, now opening offices in the Middle East to stay close to their fleeing clients. Meanwhile, back in the small town of Zug, a different kind of experiment is unfolding. This is the heart of what the locals call Crypto Valley. Since the traditional banking model is under fire, the Swiss are making a desperate pivot toward the future. They are trying to become the world's most friendly jurisdiction for digital assets and blockchain technology. It is a bold move. You watch as historic buildings are filled with servers and young programmers in hoodies, replacing the bankers in pinstripes. The government has even started allowing citizens to pay their taxes in Bitcoin and Ethereum. The scene inside a Zug boardroom feels worlds away from the stuffy offices of Paradeplatz. People are talking about decentralized finance and tokenization instead of interest rates and gold bars. This is the Swiss attempt to reinvent the vault for the 21st century. If they can't be the world's secret bank, they want to be the world's most secure digital ledger. But this pivot comes with its own set of massive risks. The crypto world is notoriously volatile, and the Wild West reputation of digital assets sits uncomfortably with the image of Swiss reliability. Finance people still go back and forth on whether Switzerland can actually maintain its high standards while embracing the chaos of the crypto market. There's also the reality of the emerging rivals in Asia. Hong Kong and Singapore aren't just taking the money, they are taking the talent. A notable event that signaled this shift was the recent expansion of major Swiss private banks into the Asian market, not to bring money back to Switzerland, but to manage it locally over there. They've realized that the days of offshore banking are fading. Clients want their money where they live and where the growth is. The legendary Swiss brand is being exported, but the physical vaults in the Alps are starting to feel a little more like museums than the engines of the global economy. One microscene that perfectly captures this identity crisis can be found in the local headlines. You see stories about historic bank buildings being converted into luxury hotels or high-end retail spaces. A massive vault that once held the secrets of European royalty might now be a chic wine cellar for a 5-star restaurant. It is a literal transformation of the country's architecture. The physical symbols of financial power are being turned into tourist attractions. It is a visual reminder that while the country is still wealthy and beautiful, the source of that wealth is shifting away from the shadows and toward the light of the service and tech industries. As you trace the path of the Neutrality initiative mentioned earlier, you see the internal struggle coming to a head. The country is trying to find a middle ground that might not exist anymore. They want to be part of the Western democratic order while maintaining the independent streak that made them famous. It's like trying to be a member of the club while refusing to pay the dues. The pressure from the US and the EU isn't going away. They expect Switzerland to act like a modern European state, with all the transparency and political alignment that entails. The realization is finally setting in. The version of Switzerland the world knew for centuries is gone. It was a version built on a very specific set of global conditions. A world of closed borders, paper records, and great power rivalries where a small neutral player could thrive. In a world of digital transparency, instant communication, and global sanctions, the black hole model of wealth simply can't survive. Switzerland isn't disappearing, but it is becoming normal. And for a country whose entire brand was built on being exceptional, being normal feels like a failure. You watch the younger generation of Swiss professionals, and you see a different attitude. They aren't as attached to the idea of banking secrecy. They are more interested in sustainability, green finance, and the country's role as a hub for international organizations like the Red Cross and the UN. They are trying to build a new Alpine identity that is based on ethics and innovation rather than secrets and tax loopholes. This is the new Switzerland. It is a country that is cleaner, more transparent, and more integrated with the world. But it is also a country that no longer holds the same mysterious power over the world's imagination. The outcome of this transition is still being written. The Titan Bank, UBS, continues to loom over the economy, a constant reminder of the risks the nation has taken. The crypto valley in Zug continues to grow, a symbol of the hope for a digital future. And the neutrality debates continue to echo through the halls of parliament, a sign of the lingering connection to the past. The Swiss are walking a tightrope between who they were and who they need to become. In the end, the story of Switzerland's failure isn't a story of poverty or collapse. It is a story of the end of a very specific kind of power. The vault has been opened, the secrets have been shared, and the walls of neutrality have been breached. The world's money is still there, but it is no longer invisible. As the sun sets over Lake Zurich, the lights in the banking towers are still on, but the feeling of being in a world apart has vanished. Switzerland has finally joined the rest of us, for better or for worse. Take a look at the world around you today, and you might notice that the old safe havens aren't what they used to be. Whether you are watching the markets from a high-rise in New York or a quiet cafe in Hanoi, the rules of money are changing faster than ever. It makes you wonder where the next vault will be, or if the very idea of a secret place for wealth is a thing of the past. I'd love to hear your thoughts on this. Where are you watching from today, and how is the shifting global economy affecting your neck of the woods? Are you seeing more people in your area looking toward digital assets, or is there a local, safe harbor that everyone is flocking to? Let me know what your plans are for the coming year in the comments below. If you found this deep dive into the changing face of Switzerland interesting, please give the video a like and hit that subscribe button. It really helps the channel out and ensures you won't miss our next story on the hidden forces shaping our world. Thanks for hanging out with me today. Until next time, keep a close eye on the horizon.